All right, well, welcome back, everybody. This is episode 3 with Wealth Influence, and today I have Bill Broaddus back in studio again. And I've convinced him to come in studio and share his thoughts and his expertise on head and shoulders patterns. And so, Bill, you're going to be sharing about that today, right?
Yep,
All
sure.
right, so we got a lot of jam packed information in this video and in this interview, actually. And so, guys, one of the things I want to encourage you to do before we go any further is make sure you join our private VIP email list below, too. So you'll get access to great interviews like this as well. So, with that being said, Bill, we're going to give the controls over to you. And we're going to start and we're going to dive deep into this head and shoulders. And guys, I want to say something else before we do that. Bill's got a special little surprise from episode 1 and 2 at the end of this interview today, and he's going to show you some things that have developed regarding gold, and so I cannot wait to get to that too. So a lot of great things are going to be covered today. We're going to talk about patterns. We're going to talk a little about psychology and all of that, but we're going to dive into it. As you can tell, I'm pretty excited. So let's go ahead and take a look at this. And so let me pull this up. All right, Bill, you take it over.
Well, Randy, we're going to start with a specific chart pattern called head and shoulders.
Okay.
And the head and shoulders, what it is, well, actually, let me back up a second. The chart patterns, when you're talking about technical analysis, that's found that there's certain forms, figures, patterns that are recurring. And when they recur, they have specific meaning on what their purpose is, what their content is, where the proximity is on the charts, and so on and so on. We're going to talk about that in a moment. But this particular one that we're going to focus on today is called head and shoulders because it reminds people when they look at it, it reminds you of a silhouette, of the shoulders, the head, and the shoulders. We're showed right on the chart here. If we just take the cursor.
Okay.
Actually, yeah, right there you can see we actually have in a yellow dotted circle there. We show on this particular chart the top of the head on this daily pound yen chart. And then the red circles there, we show the red dotted circles, we show the tops of the shoulders. And then we have a neckline here, which is in the green circles. And Randy, you can see here, we actually, the neckline, this is a little bit abstract. It's not going to be always a perfect, perfectly symmetrical.
Right.
But in this particular case, the neckline is just a little bit off. And what we found with our studies is it's best to average that. It gives us an average number. All right, because what people don't realize is some chart patterns you can, some you can't. But in this particular case, with head and shoulders, you actually can calculate targets from these head and shoulders patterns. Most people don't realize that. They've heard of head and shoulders patterns on maybe CNBC or maybe some sort of broker commercial. They're popular, but most people don't understand exactly the full scope of how you can use them.
So what you're saying, I mean, for the person who's just brand new to this information, is that these patterns exist and you can really project targets from this pattern. So when we say project a target, what do you mean? Use the cursor and show them what you mean.
Well, Randy, when we say project a target, what we're talking about here, again, let me just back up a second. This particular pattern, the head and shoulders pattern, is a top reversal or bottom reversal type pattern. Okay.
Right.
Now, the regular head and shoulders, which you see right here, is what you see as far as chart proximity at the top of a run. Okay, in preparation for a potential reversal. Okay. But when the target calculation what I'm talking about here is if actually, you know what, if we go one more step, we take a measurement from the top of the head, the highest point. It's called a swing high. This stem area right up here off this candle. We measure from that top of the head where the price is down to the neckline. And on a little side note right here, these necklines, some people believe that actually the slope of this neckline makes a difference, and that's debatable. I mean, some people are adamant about it. They believe that if this neckline doesn't slope downward, in other words, if this right side isn't lower than the left side, that it's invalid. Mm-hmm. Which, I'm not going to argue with people. Again, we're just pull out all the charts we've done in the past and show that, well, it still works, either way.
Right.
But anyway, we average those, but what we do is we measure from the top of the head down to that average neckline. And then what we do, if we, again, click down one more time, we're going to take this calculated target, put it down here, and that gives us a potential target right here. area. And if we move right there, you can see where the price. This is an actual chart, and this was actually actual price movement broke through the neckline, which go ahead, Randy.
I'm sorry, Bill, but I mean, I'm obviously I'm not a full-time trader, but I can just see obviously right when it broke the neckline, it just accelerated.
Exactly, and that's something we see as an aspect of the Head and Shoulders. When they break the neckline, there does tend to be an acceleration in the price. So anyway, that's what we saw here when the price, once it broke there, it went on down, and that is actually very technically, that is the point of entry. Is once the price breaks that neckline and goes down there, that's when you want to enter.
That's powerful.
Right.
Okay, so tell us what we're looking at here.
Well, Randy, we talked about there be reversal patterns of being head and shoulders, at the proximity on the top of a chart run. That'd be a head and shoulders. Well, actually, on the bottom of a run, once the price has fallen, we have what we call inverted. Some people say, well, that's an upside down. Well, actually, the technical term is inverted head and shoulders. And again, you can see here we have the top of the head, as if we take the regular head and shoulders and just stand it on its head. We have the top of the head here. We have the top of the shoulders. Again, we have in the green circles, the green dotted circles, the average neckline. All right, and then from here, once it again breaks that neckline area, I'm sorry, we have our calculated area first of all here.
Yeah.
The calculated amount from the top of the head to the neckline. If we go one more click there, it will probably take that right on up and show us our calculated target from the bottom. And then once there, we could click again. We can see the price movement. And we do, again, have a hit. Now, this one did meander around the neckline a little bit.
Right.
That's fine, though. It's not an issue at all. But because once it hits the neckline there, that is a fully formed head and shoulders or inverted head and shoulders pattern.
And so, I mean, just from what I noticed too is obviously it could accelerate like it showed in the first slide.
Right.
But here, even the fact that it was trending along that with some support and resistance, it gives an indication that there's something there too, right?
Correct. And there could have been a Fibonacci or some other horizontal support and resistance there in order to make it do that. Or it could have just been the time period of the market at that time. It could have been getting close to a weekend or whenever it was, where the price was just meandering and went around waiting for a break for there might have been a major news event coming up or something like that.
Right.
And we typically find that's when these things break, when it coordinates. Again, from we talked from our previous videos, that the technical analysis is the roadmap. Okay, so here's our roadmap. You're seeing it right here. And again, the news events or the fundamental analysis is the driver. Well, potentially, we would say that there's probably some major news event that caused this to break and really start breaking north there.
Awesome. Okay.
And the interesting thing about this chart, Randy, and what I did was we pulled up just a few of our slides from some of our teaching material, and that's what you're seeing here. This is some of our actual teaching material. It's very, very precise and very animated, showing how this works. But for this particular chart on the Euro-Yen daily, the price came up, hit the target, and then something very, very strange happened. Kind of a neat deal on this chart, though. It went immediately into another head and shoulders formation. We have the top of the head for regular head and shoulders. We have the top of the shoulders in the red dotted circles. And we have the green dotted circles, which show the neckline. We averaged it right here. And then from there, we calculate our target from the top of the head to the neckline. We take that distance and we bring it down as a potential calculated target. And from there, we watch the price move right down through and bam, target hit. So this is what a unique chart where, it shows how we calculated it, it went up, hit the target, and immediately turned it into another head and shoulders, and then came back down and again hit the target.
Wow.
And I say unique just because, you have an inverted followed by a regular head and shoulders, but you typically see these head and shoulders, quite frequently with the various markets.
Mm-hmm. This is powerful. Okay, next one here.
Well, Randy, we want to show people, again, we wanted to really dive in and show people how Head and Shoulders works. We're going to show people this particular Head and Shoulders. Now, let me just give you some context here with this. This down here, we're talking about we have the pound dollar. Now, this is, remember the last charts we looked at were like daily charts. This is a 15-minute chart, so a much shorter time frame. Because we actually use Head and Shoulders, we've seen with our research, all the way from the 5-minute charts all the way up to, we see it on monthly charts.
Yep.
Wide variety, depends on what type of trading you're doing. But with this particular technical analysis, in this example, we're on a 15-minute chart here. Now we're going to show you, this looks like we've got a run up here, and we have what appears to be a beautiful head and shoulders formation has formed here. We have the top of the head, the top of the shoulders in the blue circles, and in the green dotted circles we have the average neckline. So we're thinking, okay, a person might see this, and if they focused on this one chart, they might think, wow, this looks like a great textbook head and shoulders pattern. And if we go one more click here, we're going to show our measurement, our calculated measurement, and then we bring that down to show our potential calculated target. And if we continue on to check out what the price movement does, we're like, whoa, wait a second. We thought these things were reliable. Why is this thing taking off in the wrong direction on us?
Right.
Well, what we need to do, Randy, is people always need to make sure that we keep track of the context of what's going on within the time frames of the larger charts too.
Right.
With our teaching, we always teach people, you always have to have a full view, not just focus on one area, one thing, one particular item. We like people to always keep their eyes open, keep a bigger mountaintop view, so to speak. And we're like, okay, now why would this pattern, when it looks so nice, why would it possibly have failed? Because we know the head and shoulders is one of the most reliable patterns that there are. Well, what we need to do is we need to go from the 15-minute chart, we need to look at the bigger charts and find out exactly what's going on there. So if we go to the next chart, we show that the pattern is failing and why. And here we go to our daily chart. We went from a 15-minute now to our daily, and what we're looking at here, the daily chart has shown that we've had a major run down, all the way down to here. And what we've done here is I put some lines showing the context of where that head and shoulders pattern was. And if you look at the green line right here, our head and shoulders was actually right in this area right here. And this green line would have been the neckline, okay, to go south. All right, and then our calculated target, we would have saw, I have a red line here to show where our calculated target would have been right here. Well, Randy, in the context of this daily chart, you can see the price has made a major movement all the way down here, and all of a sudden now in the context of the 15-minute look fantastic, but when you look at the daily chart, we're trying to, a person would be trying to take a head and shoulders pattern, and use it south on this move that has just now made this major movement down and has probably got a lot of energy to go back north now. You can't do that.
Right.
And actually what I did was I don't have the Fibonacci retracement tool actually drawn on here, but I have the measurement drawn here, whereas if you started a Fibonacci retracement tool up here, like we talked about in one of the previous videos, if you would have started it up here and drawn it down to here, the 23.6% retracement line would have been up here. And that's our first fib line that we would have expected a retracement to from a long drop like this. Well, my point of telling you that is that the price at this particular point had not even reached our first Fibonacci retracement line. And, on the 15-minute context, a person, if they were, using, narrow vision there, they would have been trying to take a head and shoulders pattern south before the price had even retraced to the 23.6 line, which is not a good idea.
Bill, I'm just taking a step back and I look at this and I look at this information and in our interviews together, and the thing that you keep emphasizing is building that case. And and I think about those people who are out there maybe using software programs and trading programs, and they have one specific tool that they're using, but they're not building the case. And right here is a perfect example where you used Fibonacci, you used different time periods, and you used the head and shoulders to really identify if this thing was, if the bias was really there or not, if it was going to go that direction or not. And I think that's something that for our subscribers to really pay attention to is what Bill's talking about is that even if you're out there and you're an experienced trader and you're using a software or something, is that, taking this type of information and building a stronger case for what you're doing, it's going to help you in the long run. And so I just wanted to throw that in there because, looking at this information and putting it all together, Bill, this is just extremely educational and resourceful for everyone to really pay attention to. Right.
So this just kind of gives you the context, Randy, of, because we want to show people both sides. Are like, because this is a very reliable pattern, but we want to show people, if they do have a fail. In other words, once the head and shoulders pattern has fully formed, where you have the right shoulder where it's come back down to the neckline, that from that point that's a fully formed head and shoulders. Okay, and if it fails, why would it fail? Well, it doesn't actually fail because if you got to look at the context here of where it's at and what you're doing.
Exactly.
Because we use all the way from the monthly chart, like I've told you in the past, we use all the way from the monthly chart down to the 1 minute chart, depending on what we're doing. But we always try to keep an eye on everything, knowing that one particular chart can really make a difference with what's going on with that particular market at that time.
Everyone's probably wondering, how in the world do you keep track of all those charts? How many monitors do you have in your office?
Well, and again, I don't want people to think because you have to have this to trade, but because of the research that we do,
right?
We have about 18 main monitors, we have a really broad view of what's going on, and that's where we've been able to see and really
Right.
document in the context of situations like this.
Right. Absolutely. Okay, so did we cover everything on this slide, Deb?
Randy, we did, except for one thing. We might want to go back to the first slide.
Okay.
Because something we might want to point out to people is what's going on here. Something we didn't talk about was the psychological effect. And if we want to go ahead and just go down one more click to show that,
Yep.
Perfect, right there. What's going on here is you have people. There's actually a psychological. All these charts they show price movement of a particular market, but what they also show is the what's going on from a psychological standpoint with people. And this is something we want to touch on. And again,
Now, are you saying that people trade on emotion, Bill?
just a little bit. Actually, about 95%. That's why 95% of people lose money with the markets, because
That's right.
they get involved with emotions. And something I've touched on in the past, Randy, is that I had one of them, powerful mentor in the past. He turned me on to a book, and it's again we love these older books. Because
Right.
these guys have gotten into some wisdom and knowledge is just incredible. But one book that we've gotten into that one of my mentors recommended is How Charts Can Help You in the Stock Market. And there's a whole chapter in here that he talks about, head and shoulders patterns that is excellent. And one little part of the chapter that talks about head and shoulders, it's actually by William Giler, just to make sure I'm clear on that. It's How Charts Can Help You in the Stock Market
Right.
by William Giler, 1962. Okay,
Yeah.
so it's about 50 years old now. But it talks in here about what's going on with people during this head and shoulders pattern. Well, Group A right here is the top of the left shoulder.
Yep.
And those people actually, they start down here. Group A actually starts down here and runs up into this point up here. They're the ones who have already gotten in the market and they're making money at this particular point in time.
Right.
And when you get into this group, actually it is Group A. Let me see here. Yes, Group A is the ones who have missed that, but they got up to here and all of a sudden they're like, okay, Uncle, we're going to get in.
Right.
Because Randy,
Right.
let me just back up a moment. We talked about a lot of times we will notice three waves that hold a lot of power.
Right.
And it's interesting because the first wave, you've got people that have recognized a good opportunity to get into the market. Okay.
Yeah.
And then you usually have a retrace, and people are like, well, see, I'm glad I didn't get in till now. So then there's a next group of people that gets in like, okay, but I missed the first part, but I'm going to get in this middle part. That's the second wave up. Okay. And then you get the third group who are like, they missed the retrace, and all of a sudden they get to the top of the third wave. They're like, oh, I cannot stand it anymore. I'm getting in this market. Well, that's usually about when it heads
goes
the other
way.
direction. Okay,
Right,
so that's why
right.
they procrastinate until exactly the wrong time.
Right.
I used to have beginning traders used to tell me they used to sit here and they get so frustrated. They finally get to the point they miss an opportunity. They're like, click a button. They're like, okay, I'm in, and they would, and all of a sudden the price would just literally rocket away from their position backwards. And they would swear that somebody's got a video camera over their shoulder just watching.
Right.
But it's because the markets move in a way, to entice people into the markets and then take it away from them.
Right.
But, again, we have people that have, with this particular, the psychology behind it, we have people that have been in the market, gotten in, they've ridden it up, and they're in the money. You got other people who are waiting and then gotten in and, later, and they're going to make a little bit of money. It's going to take them a little bit to get in the money. But then we have the last group I told you about, the Group C people who say, look, I can't stand anymore, I'm getting in, and they get in exactly in this area up here at the top of the head.
Bill, I think about it like this, where, our audience here is probably, if you've ever been told that you're predictable, how much more so are you predictable in the markets? These, those on the other end of that trading screen, they know what you're doing because you're predictable.
Absolutely.
And that's what we're talking about here. There is a psychology in the market, and identifying these patterns is so critical if you're going to be a trader any length of term of if you really want to be in this game for a while, if you want to really sustain yourself, you need to understand this stuff Bill's talking about.
Yeah, and Randy, I'm not going to dwell on this, but the point is that books like this help people understand that
Right.
the market movements are meant to to draw people in, entice them in, get them to enter. They know how people are, enter at almost likely the worst possible time, and then take their money away from them. But the thing is, if people read the books, such as this book, okay, because there's a lot of trading books out there, tremendous
Right,
amount,
right.
and most of them just don't have this type of information. But if they understand this and see the playbook, then they can actually alter their movements and their decisions and what they're doing, because they've seen the playbook. Does that make sense?
Yep, and trade based off of patterns rather than based off emotion.
Instead of based off emotions, exactly.
Right.
Because there's psychology behind all this. And again,
Yeah.
it's too deep to get into all this right now, but people can get this book and start reading this. They're going to be amazed when they see the psychology behind these chart patterns
Absolutely.
and the market movements.
Great information. So let's go ahead and exit out of here. And then we put a little bit more information together, and we'll pull that up now. Okay, so let me... All right, so tell us what we're looking at here, Bill.
Well, Randy, I believe it was the last session we talked about the Dow and what the Dow was doing, and here we have a picture of the slide that I actually had, and there was multiple waves up. There was 3 large waves up since the drop back in 2007,
right?
Where it actually bottomed. I think it was March of 2009 and started way back up. From the time it bottomed in March of 2009, where the Dow has been coming up, and there was three large waves, which you're going to see in a moment. But of the third large wave, the last wave of that, this third wave of the third wave, is what we showed on the last video that we did. And at the top of that wave, we showed this head and shoulders pattern forming. Okay, and it's actually kind of nice. We have the left shoulder up here, the neck, the left neckline. The top of the head, the right side neckline, which we would average those two, and then at the time that we did that video, we were at the top of the right shoulder. And remember what I said at the beginning of this head and shoulders discussion. This pattern is not completed until it comes back down to the neckline.
Right.
Which, if we go ahead and forward now on our next slides, actually here's the context of what I was just telling you. Here's the bottom that we had back in March of 2009. We had this major wave up with 3 small waves within that wave. We had the major wave 2 again with 3 waves in there. And then we had this wave 3, which is this large wave 3 right here, which is between this red line and this red line. And again, you can see 3 major waves up here. But the area that I just showed you with that previous chart was actually this little area right here. From here, there's 1, 2, 3, and then here was the little head and shoulders right here at the very top. So you can see in the context here, like we talked about with that one chart pattern that failed from the 15-minute, we're not in that type of scenario where, okay, we just kind of moved back up off the bottom. This thing has really came up 3 very large waves since 2009, and we're at the top of the third wave of the third large wave here.
So even though, I mean, in observation, obviously, there could be an expectation that this thing's going to move south, but you need things that are going to confirm it. You need multiple things that are patterns that are going to confirm what we're seeing on the chart.
Exactly.
Okay, so let's tell them what we're looking at here.
Well, here's what has happened since that time. And again, here's the first slide that you had seen with the 3 waves and the head and shoulders pattern here at the top. And here's where we were at, right about this candle right here is where we were at the day that we did that video. Mm-hmm. And again, in order for this to be a complete formation and say, okay, there's a head and shoulders pattern, it has to come back to the neckline, all right? Well, you can see from that day, it actually just kept going north and bam, and it has continued to go north and just continue to break on higher from here.
Right.
And I made a few notes here about this, okay? Because, again, it didn't actually, we could say, well, that head and shoulders was invalid or it failed. Well, no, it didn't. Actually, technically, it never completed. It never actually formed a complete head and shoulders, so it didn't fail and it wasn't invalid. It just never completed.
And so, and again, just to clarify, in order to confirm or to deform a complete head and shoulders, it needed to come back down to the neckline.
Correct. From this point here where we were at the day that we did this talk, okay, we were looking for it to come back down to here, right across here. It would have needed to come down to there in order to complete. And then once it completed, then we would expect if that would have been an entry point to break south, these blue lines here would have been the calculated target, because from our neckline right here to the top of our head, that distance right there, we measured from the neckline down to these blue lines right here.
Right.
Okay. And that would have been a calculated target. But the point again is that the head and shoulders pattern, and this is a critical area right here, Randy, that people have to watch out for. Because that's where, it's either going to head on down here and complete this pattern. When I say complete, I mean complete the formation to say this is a valid head and shoulders, not a completion of where it hit the target, but a completion of the formation would have been down here. But instead, from there, it just started taking off north, floating north. And another key thing is, you're like, okay, well, let me go down to my notes right here. You're like, why did that happen? Well, first of all, we're not in a typical situation with the Dow where you would expect the market is just it's moving higher because we've got so much. The corporate earnings are so fantastic, and all these other numbers that we're getting, the financials are just looking so fantastic. It's not that way right now, Randy. We're in a strange time where there's a couple points here. We're still in QE infinity, and for any people that aren't familiar with those terms, that's quantitative easing infinity. We went from QE1, which you saw those 3 waves north.
Right.
From the bottom of March 2009, we got into quantitative easing number 1, where the Fed came in and artificially started pumping things up, and we had a nice bounce off the bottom. The price retraced, and then what happened then? Well, we things started slowing down. Fed has to start, bam, quantitative easing number 2. They start pumping money and manipulating the market.
They're inflating. They're just pumping this money right into the economy that really is not
to artificially prop it up.
Right, exactly.
Right. And so what happened with that? Well, we saw again, if you remember wave 2, wave 3, or the first wave actually was a pretty strong movement north, okay? But then it started retracing back, QE2 kicks in. But what happened, Randy? We didn't see near as much movement north from the quantitative easing. It's not working as well, in other words.
Right.
And there's other little programs in between there, but by the time we got to QE3, we're seeing very little reaction of the market to that.
That's pretty telling, Bill.
It was very telling.
It's people should be wise to pay attention to that, and just take that into consideration.
Well, yeah, and then we went from these little various programs. I'm not going to name them all, but then we went into what they call now QE infinity. They quit numbering them. They just said, look, whatever it takes.
We're just going to do whatever it takes.
Whatever it takes, pedal to the metal, man. We're going to pump this up, and no matter what it takes, it's going to be pumped. But the problem with that is, Randy, is that, okay, from the Great Depression, the issues that we run into is all these safeguards, all these band-aids, all this stuff that they're pumping into there, okay, it appears to be working, but what are they going to do when QE infinity quits working? That's the point. So all these band-aids that are in place, once they give out, if they don't actually start gaining traction, if they actually start losing traction and going backwards, where do they go from there? All those band-aids are actually going to possibly make this potential event that much worse than what it would have been, if that makes sense.
No,
I'll leave it at that.
It totally makes sense, and hopefully everyone that's watching this is listening to what we're talking about here, because this is a much bigger picture than just this informational, educational interview that I'm doing with Bill. So, guys, take that for what it's worth.
Okay, and I know we're focused on. I don't want to get too far off the track of our head and shoulders pattern already, but a couple of things we're going to look at right here too is this head and shoulders pattern. We can't ignore a couple other little warning signs. All right, first of all, we have what's called a dragonfly doji right here, which is followed by a large black candle.
Yeah,
that's again a heads up. The market could be heading south. Again, we got to keep everything in context of a lot of other things. And then again over here we have another what we call a hanging man candle. This one right here looks almost like a hammer, but they're called a hanging man because of where it's at on the chart. It's at the top of a run, followed by again a large black candle. Now the price has run up since then, and some traders may say, well, Bill, these 2 large candles here, that cancels all that out. Well, the only thing I'll say, Randy, is that these 2 large candles here happen to occur on Thursday and Friday of non-farm payroll. And again, I don't want to go too deep into this, but non-farm payroll, as you know, is a one. It happens every month, and it's the jobs report. In other words,
right?
It's called non-farm payroll, where they release the jobs report, to judge what's going on with the economy and stuff like that. So, anyways, so that when you have price movement occur on something like that, that it can be revised, it can be changed. There's a little bit of you wonder if that's really that legit or not. Okay, and again, this thing. Looking from we want to keep things in perspective here because we want to keep an open mind. And remember, with when we're building a case, we let the charts tell us what's going to happen. So we don't want to become too bearish where we think that okay, this thing's going south and whatever. We want to be aware that this head and shoulder, what we thought was a head and shoulders pattern forming, which never actually completed the formation. It appears the market right now is bouncing off of what we could see I don't want to say a double bottom here because we're at an area here, but it's at the same point we have a point of support right here.
Yeah.
Where there is definitely some volume that's being, that people potentially went short too soon there, that are stuck, in other words.
Yep.
So anyway, I want to point there's a few things out. We need to keep an eye on one thing that's critical to with Head and Shoulders, and again, people can find this information in this book. Is watch volume. When you see this whole Head and Shoulders formation happening here, you want to watch the volume, because when the Head and Shoulders is happening like this, volume will actually start tapering off and decreasing. And if you see a Head and Shoulders formation, starting to come together like this, but you see the volume increasing, staying steady, or increasing, you're more than likely going to have, the price continue on north from this.
Okay.
And again, I know I'm throwing a lot out here, but I'm just
right.
trying to show people, this is kind of the technical analysis that we use and that we teach.
Okay, great. Let's go to the next slide.
Sure.
Okay, what are we looking at here?
Randy, this is actually the weekly view. What we were looking at before was daily charts. This is actually a weekly chart. And we showed this in the previous video that we did.
Okay.
And the point of this was, here's those 3 large waves forward after the bottom of March of 2009.
Yep.
And you can see here, the thing we pointed out on that last video, that again, something that was potentially an additional bias for the price moving south was, along with the Head and Shoulders that was forming, was that we had a bearish engulfing pattern. I just want to point people out, we showed that, but again, I want to show them again now an updated chart where that engulfing pattern has even, the prices again moved on north of that. So this is just something that we need to continue to watch, and this is what we do like on a daily basis. We watch movements like this,
right?
And again, build a case. This was a breakout type of a situation. But I'm, because of the underlying fundamentals, I'm still not convinced of the strength of this move north. It's definitely, artificial.
Right. Good information, Bill. So, Bill, you wanted to include this. This is from episode 1 and 2 that we did with you when we were talking about gold and Fibonacci's in
right.
episode 2. And I think this is informative, and it's time sensitive in some ways, because what you're going to talk about now is we did these interviews and everything's dated on the website, and so we're not this is all live educational training we record it here in studio. But Bill, tell them what we're looking at here.
Well, Randy, the other day we spoke about gold and what was going on with gold, and we showed the weekly chart, which we don't have it on here, but we had of course everybody knows a very strong climb north. Right. And from there, the price went up and down in that area. And for the people that did see that, we actually had drawn a large Fibonacci on the weekly chart, showing that the fib that we drew was actually on the last 3 waves north. We drew a Fibonacci, and we showed how we projected the price was getting ready once it broke a trap area that we had, that we had shown. Once it broke that area, we were waiting for this entry to enter south, and the fib that we had there, we had a different areas targeted, but one area we had targeted was this area down here, which happened to be the 78.6% retracement line of those last 3 waves north that we had. And
right.
Sure enough, the price fell off. It went through the various fib lines down to just stopped just short of that 78.6 line on that larger weekly fib that we had up. But what we're showing today is, and I mentioned on that video the other day, that the price had started back up, and
right.
and I said, we're expecting, or we're looking at it anyway, we're watching this 61.8 area here, and we just want to show people, again, this red line right here is the 78.6 of that larger fib that we had on the video the other day. This red line here is the 61.8 retracement line of that larger weekly fib that we had. But right here, what we've done is we've drawn a shorter fib now. On this 4-hour chart. This is actually a 4-hour chart, much smaller time frame, and we've drawn a Fibonacci retracement tool on here, and again the price got up almost right here to the 61.8, but it's meandered around, and we still have that 61.8 line that I've drawn in here as a residual. The price has been bouncing between these lines in this area, and even I mentioned about non-farm payroll last Friday.
Right.
Okay. Here's where the non-farm payroll day was on this particular 4-hour candle.
Wow.
Bounced
Look
up,
at that.
hit the 61.8, went just slightly pierced it, and actually on that same day went down and hit the 50% line of that fib. Stuck within the. Again, we want to show. I just want to give people an update on showing the power again of the Fibonacci tools.
Yeah, I don't know. I don't care who you are. If you're looking at that, there is that shows that there's something about that. There's
right.
something about this Fibonacci sequence in this right here. It's just obvious.
The whole principle, the theory, and everything, and you can see it just on this one day. And again, non-farm payroll day, Randy, as you're aware, I mean, a lot of traders, they just back away from the computer and just sit on their hands.
I'm sorry, Bill. I tell you what. One other little tip then. Tell people how they could even know when non-farm payroll is. What website could they go to?
Well, one of the main websites that we teach our students, is to go to forexfactory.com.
Yep. Okay.
It's an excellent website, and it says forex. It's forexfactory.com, but at the same point, the news.
It's all the news on there.
All the news is very detailed out, but it's in a way that anybody can understand it.
It's not just the news is there, but it tells you when that information is going to be announced. Like when is the next non-farm payroll going to be announced, right?
Well, yeah, and it will show you exactly.
Yep.
And actually, for each news event, it tells you, it gives you like either a red folder, a yellow, or white folder, depending on the intensity, how much impact it's going to potentially have with the markets. And you can actually click on a few more buttons if you want to say, well, I don't understand what's non-farm payroll. What is that? Well,
right.
You can click on another little button right there, and it will give you a detailed explanation, pretty decent explanation of it. And it will also, if you click on another button, it will show you a chart showing what's happened in the past with the previous non-farm payrolls that came out and how it affected the markets and things. It's excellent site to use, and people can see. And again, as you're aware, a lot of traders, they will just, like I said, back away from the computer, sit on their hands during that day, or just take the day off because it's just a very volatile day.
Right.
And some people can really, if they don't know what they're doing,
they can really lose,
get hurt on that day. So,
right.
But you can see even from the gold here, what has happened. It's in that day alone, it went from one Fibonacci level all the way, fluctuated between that before it moved on. Then, so anyway, Randy, I thought that was kind of interesting that people might want to follow up just to see, what actually did occur, and again, how the Fibonacci tool again was very relevant with this.
Awesome. Well, I think that about covers what we wanted to hit on today, right?
Sure did.
All right, well, guys, everyone, a lot of great information. Definitely just powerful information from Bill. So here's what I want to encourage everyone to do. One last time, make sure if you have not subscribed to our VIP email list, you need to do that because you're going to continue to get great interviews like this. And so just do that today. And Bill, thanks again for coming in.
No problem, Randy.
All right, thanks, guys.